The cost of buying property can be wildly expensive and one of, if not the biggest hurdles. I mean, the Mount Everest of hurdles is trying to scrape enough of a deposit to buy your next home. But there are options, more specifically, 3 options. Hey everyone, Luke Z from SF Capital here, and in this video, I'm going to show you the options available to help you make the most of your hard-earned deposit. I'll even show you how to access a higher purchase price than you expected with less deposit. When buying residential property, if you go with what lenders consider as a safe deposit amount for them, then you'll be stumping up 20%, which not everyone has just lying around right now. You may hear that you can put as little as 5 or 10%, but this comes with some strings attached. Firstly, you incur a one-off fee called Lender's Mortgage Insurance, or LMI. This insurance protects the lender in the event that the sale of your property does not cover the outstanding loan funds. However, it does not change your normal repayment obligations. Secondly, since it's deemed a riskier loan, you face higher rates and tougher policy restrictions. These vary depending on the lender, but can include limited lending to certain types of property in high-density postcodes and having to prove your deposit is made up of genuine savings. Genuine savings is simply funds you've accumulated over a 3-month minimum period in your name. But if that's not the case for you, and instead of genuine savings, for example, if you received a lump sum, some lenders in conjunction with this also consider clean rental history through a licensed agent as a way to consider whether you satisfy their genuine savings criteria. Now, while it sounds like a painful exercise to acquire a loan with a deposit that's less than 20%, thankfully, there are 3 options to work around all of what I just said. Number 1, using equity from an existing property. This is a strategy that a lot of our existing clients who have bought their first home or investment property deploy with our help to buy their next home. Equity is the difference between your current property value and the existing loan. If you are paying down your loan and or the property has increased in value, then your equity value has grown over time. You can borrow additional funds against this equity to fund the deposit of your new purchase. When these funds are released, it is known as a cash out or equity release. Typically, we suggest a separate loan split for these funds on a variable with offset interest-only structure. So during the interest-only period, there are no interest or repayments incurred until the funds are used. The maximum amount you can access before incurring lender's mortgage insurance or LMI is 80% of this equity value. If you have enough equity value, you may not need to put any cash towards the deposit. But remember, this is borrowed money, so you need to get a current bank valuation, demonstrate borrowing capacity, and meet the lender's credit criteria. Maximizing the bank valuation and your borrowing capacity is what this option hinges on. Number 2 are family guarantees. This is a popular option for first home buyers because if you don't have an existing property, but your family does, they can offer it as additional security for your loan. However, it is also possible to use this option for next home buyers, provided there is insufficient equity in your existing home or investment property. Otherwise, you would revert to the equity release option we previously mentioned. Your family members would become what's called guarantors, and that allows you to put in as little as 0%. Yes, 0%. The caveat though is that while you are still responsible for all of the day-to-day repayments, in the event of default where you can't pay and selling your property still does not recover the loan, then the guarantors are required to pay. This should be viewed as a temporary solution because once your loan reduces to 80% of your property value, then the guarantee can be discharged. But beware, there are many legal and financial considerations and other strict conditions, so you need to seek the relevant professional advice first. And finally, option number 3, LMI waivers for industry professionals. For medical, health, accounting, actuarial, and legal professionals, certain lenders will waive the LMI on loans with deposits as low as 5%. You even circumvent the genuine savings requirement we mentioned earlier. This option does come with a suite of requirements though, and different lenders apply them differently, or they may not apply at all. For example, some lenders have a minimum income hurdle. Some have mandatory principal and interest repayments. And you may still face the tougher policy restrictions of limited lending to certain types of property in high-density postcodes. Regardless of that, you would save at least thousands, if not tens of thousands, on the LMI. And if you use a broker that specializes in this area of lending, you often find you'll fit a certain lender's criteria and get the most out of this option. Especially for those next home buyers, you can even combine this with the LMI waiver and the equity release strategy. So 3 different options, or should I say solutions. There's using equity, family guarantee, or an industry professional LMI waiver to buy your next home sooner. Because of the complexity of these options, it is recommended that you speak to an experienced mortgage broker to navigate the nuances, as they are always changing and vary substantially between lenders. If you know someone who's looking to gain an advantage with their deposit, share this video with them so they too can conquer the Mount Everest of having a property deposit. Make sure to like, subscribe, and comment.